Hi everyone, my guest today is Rick Rule, who is always worth listening to. So, Rick, welcome to the spotlight.
Thank you, Peter. And apologies in advance. I have a pretty ugly head cold.
Oh,
So if something sounds wrong with the audio here, it's not the technology. It's in fact the person being interviewed.
oh, we wish you the best for sure. Um, so we could continue with our last discussion with some questions, perhaps some grading of stocks, if you are possible with, if you can. Um, But before we do that, I enjoyed all your educational boot camps, and today is Thursday evening according to my time zone. And this Saturday you have the Tier 1 boot camp. What can we expect there?
Uh, for those of your listeners who are unfamiliar with our boot camps, they are 7 or 8 hour long deep dives into single topics around natural resource investing and speculating. We've done silver, we've done uranium, we've done prospect generation, we've done royalty and streaming.
Right,
These are education projects that are not for tourists. They're not for people who are looking for entertainment and amusement. These are very dense, deep dives that are meant to change the way investors think about certain topics that they haven't probably thought enough about to participate in. What that means is that we're going to work our participants very hard for 7 or 8 hours. We're going to give them access to the tapes for a year, and they're going to need that access because we're going to give you more information in 7 or 8 hours than you can absorb unless you're already deeply familiar with the subject. The subject that we cover this Saturday is going to be Tier 1 deposits, defined by myself as multi-generational assets with in place recoverable reserves and resources exceeding US $10 billion at current commodity prices, with the ability to generate annual revenues in excess of US $750 million, where the deposit will or should be in the lowest cash cost quartile in its commodity worldwide, and where the return on capital employed should be in the best quartile worldwide in its commodity, but at any rate, exceeding 25%. These deposits are very rare. And by the way, $10 billion in in-situ recoverable reserves and resources is my minimum. I would prefer 30 or 40 billion dollars. These are assets that give investors access to decades long free cash flows. They're ones where, after project payback has occurred, the amount of reinvestable or distributable as dividend cash flows can be extraordinary. And they can be extraordinary for up to 30 or 40 years. They always yield exploration surprises. And those surprises are always good. In other words, the resources that are present at the time that the mine is put in production almost certainly increase, and production almost certainly increases. Many good surprises. And they're long lived enough that two things happen. They can survive mistakes. If you have a mistake with a small mine with a short reserve life, you never recover. If you have a mistake with a 30 or 35-year reserve life, if you have a couple years out, it isn't helpful, but it isn't fatal. And the very long reserve life gives you plenty of exposure to commodity price upside. If you think, as an example, that the silver price is going to increase next year, but it takes 3 years from now, if you have a silver project with a 40-year mine life, while the 2 or 3 years is unpleasant, it's hardly fatal. You've captured most of the price upside in silver as a consequence of the duration of your ability to produce. All of these attributes make Tier 1 deposits highly coveted by the mining business, which means they're at the focus of intense merger and acquisition activity. And that means, in addition to the fact that you can count on substantial dividend yields over time, you can count occasionally on being the beneficiary of a very premium price takeover. So for all of those reasons, for both investors and speculators, a deep dive in tier one deposits, how to identify them, how to speculate in them, how to identify them, how to model them, is, I think, a very, very, very important topic. We charge listeners $99 for this product that gives one access to the recordings. And for anybody who doesn't feel that they got their money's worth, we offer a 100% refund. I'm sorry. It's important to note that in 28 years of offering full money back guarantees, we've only had to refund about 0.1% of our tuition charges. But the offer remains. The financial risk is mine. The time risk, of course, is yours. And one more time, I'll warn you, do not come to this boot camp if you're a tourist. This is not an entertainment product. This is an educational product. It's the difference between grad school and going to the movies. So if you intend to go to the movies, go to YouTube. If you intend to learn more about how to be a better investor and speculator in natural resources, come to the boot camp.
I agree with you. And could we say that perhaps it is one of the best part of this sector with what beginners should start to invest in?
I think experienced people, when I look back, Peter, at my own investing experience over 50 years, I did a lot of things right. I've done a few things wrong, but mostly what I've done right is in the speculative phase, backed only very high quality people. When I've gone away from high quality people, I've often had bad results. And on the project side, the bigger projects have made me more money as an investor and a speculator. On occasion, probably single projects have made me more money. Single big projects have made me more money than all of the money I've made in small projects combined over 50 years. When I look back at my own life, and I think if I had only concentrated on very high quality people as a speculator and very high quality projects as an investor, not looked at optionality or other things like that, I would have worked 25% as hard and I would have made 4 or 5 times as much money.
Yeah. It's a great recruitism.
Yeah.
And also I think that one success in this part of the business can pay for many mistakes, or at least multiple mistakes, what we all have. Okay, I look forward to it. So for the viewers, you find the link below. Go to it and make use of it. Okay, so then I got again a lot of questions. Alex is asking that oil and gas are politically hated now, but actually the good quality companies are good investments. Do you view coal similarly?
The number of good companies in the coal business is much smaller. So you have to be much more particular in the coal business. And the high quality coal stocks are uniformly up 200 or 300% in the last 3 years. Unfortunately, the very best coal producers in the world are large multinational mining companies like Glencore that produce various commodities. The best companies in the coal sector are not pure play coal companies. So investors need to understand that. As in an investment topic or an investment sector, oil and gas, because of its size and because of the selection available to investors, is a much, much, much better sector. Income investors can pay some attention to coal. Speculators are going to have a much harder time because it's so capital intensive and because security of supply is so important that newcomers into the space have a very difficult time competing with incumbents. But income investors may want to look at coal. Again, if they're buying the tier one coal deposits, very often they're buying those in wrappers like Glencore
Mhm.
that are also important copper producers and nickel producers. So while they're important to coal, coal is less important to them.
Yeah, it's a byproduct for them. Okay, okay, thank you. Maybe I can ask your opinion about a few related companies, at least for the oil and gas sector, because I have those. We can jump to that. What do you think about Exxon?
Exxon is probably my favorite for most investors.
Mhm.
It's very large. It's very liquid. They have a 30-year track record as great allocators of capital.
Mhm.
They speak on the quarterly conference calls about reserves per share, about free cash flow per share. In other words, the managers of Exxon think less about Exxon than how Exxon rewards its shareholders, which is refreshing.
Mhm.
Despite their enormous size, they have made a discovery or series of discoveries offshore Guyana, now reported to be 18 billion barrels, that's large enough to move the dial on Exxon. And while most of the industry worldwide is underinvesting in sustaining capital and new projects, and therefore impeding their ability to produce 3 or 4 years out, Exxon, even while rewarding shareholders, is making the necessary sustaining capital investments, and even fairly recently investing $60 billion to buy Pioneer to increase their Permian footprint. If I had to buy one oil stock worldwide, I don't, but if I did, that would be ExxonMobil.
Mhm.
Don't buy it because you think that something's going to happen over 2 or 3 months.
Yeah.
Own it because you intend to benefit from their stewardship of your capital for 5 years or 10 years.
Mhm. Yeah. And you would grade them as a 5 or 6?
I have Exxon at current prices as a 4.
4? No. Great, great, great. And what about Blackstone Minerals?
Blackstone is a much smaller company.
Yeah.
Probably not suitable for non-US investors. It's a royalty company. Um, Usually, I should say, most of their assets are quite high quality. Some of them are junk, but most of their assets are quite high quality. The only concern I have about the company, by the way, I own it, is that many of their undeveloped locations, or the undeveloped locations that they hold royalties under, or put differently, many of their tier one locations, their A grade locations, have already been drilled. So their ability to continue to increase production, which has been phenomenal over the last 5 or 6 years, is constrained. If technologies around horizontal drilling and fracturing continue, they may be able to continue production increases.
Mhm.
If recompletion technologies continue to improve, then Blackstone continues to improve. If they don't, the circumstance in front of us could be that their production plateaus.
Mhm. Okay, thank you, thank you. And I got questions concerning, yeah, portfolio allocations, building a portfolio. Yeah, it's tough, I know, because you also don't give personal advice, so it is not viewed like that, and it depends on, yeah, individual knowledge, possibilities, and so on.
Correct.
But I try to squish it in a way that maybe you can answer it. Um, Imagine, with all due respect, you are now 20 years old and you start investing. With your knowledge of the credit cycle and such, how aggressive would you be today with investing?
If I was 30 years old today, I would be much less aggressive than I was when I was 30 years old last time.
Hmm.
Uh,
Despite that it worked.
Much, much, much less aggressive.
Okay.
What you find in natural resource bull markets is that they're so dramatic that if you merely capture the market beta,
It is enough.
the extent to which the sector outperforms the broad market, you do quite well. If you look back as an example over the gold equity cycle, in a gold bull market, the index gives you 300 or 400% returns. So rather than working so hard to outperform the index and taking all that risk, being in the market, capturing the beta, in fact, capturing only 85% of the beta by owning the highest quality companies is something I would have concentrated on. When I was 30, probably 80% of my portfolio was speculative and 20% of it was investment grade. Knowing what I know today, if I recycled myself back to being age 30, I would reverse those numbers. 75 or 80% of my money would be in the very highest quality companies. And the 20 or 25% that I was speculating with, I would only have speculated with extraordinarily high quality managers. The Lundins, the Friedlands, the Bob Quartermains, the Ross Beatties. I wouldn't have paid attention to anybody who hadn't already made me money by age 30. And if there weren't any attractively priced offerings that were coming up from that club of superstars, I'd keep that speculative money in cash. I wouldn't play with it. Now, you framed the question in terms of me.
Yes, yes.
So I gave you the answer in terms of you, but I would suggest that, I've graded tens of thousands of portfolios, as you know. And I would suggest to you that the most common investor mistakes are that people own too many stocks. They own more companies than they could possibly follow. While they consider themselves to be investors, they're speculators, and they need to acknowledge that to themselves. And people employ short-term strategies around long-term narratives. If you think the copper price or the oil price is going to go up in 5 years, and you invest with a 3-month time frame, you almost certainly are going to lose. You need to synchronize your strategy and your tactics, and most people don't do that.
Yeah. When I talk with people about money and how they should invest, to teach them, I have to. So what I want to say is that very often the best advice we can give is something they will be not happy with, but that's the best, and they have to accept that. Also, when I talk to you, also in person in Boca Raton 2 years ago, this year, you tell me that, yeah, Peter, you just have to work. You don't have. You should not skip the hard work. It's not what makes me happy or the viewers happy, but it's just how it works.
Right.
So yeah, we should accept that.
Before your time, there was a spectacular speculative newsletter writer named Bob Bishop. He confined himself to small caps and speculation. He didn't have a geological background, but he had an extraordinary nose for a story. And he had great context. He had a great Rolodex. And what Bob Bishop said publicly is that when his service was the most valuable, there was the least demand. And when there was the most demand, it was the least valuable. And that's an interesting paradox. I remember maybe the first time you interviewed me, many years ago, doing everything but calling people's brokers to get them to buy uranium stocks. Uranium was about $30 a pound, and nobody cared. Yeah. And when uranium went through $100 a pound, everybody cared. Now, that goes back to, if you have a 5-year narrative, you can't employ a short-term strategy. You can't do it because the price action in uranium hadn't justified the narrative. People didn't want to hear the story. So what you suggest is very much true. And for people like you and I, we have to sacrifice the number of views in a video. You get much higher views if you talk about things that are popular.
Yes.
In favor of delivering more value
Yeah.
to people who can pay attention to the strategy and methodology that we put forward.
Yeah. Because I think we do this not because we have to. It's not, our living is not depending on it, but we do it also from passion, and we would like to give value. And I'm happy that you brought this mistake up, that people are waiting for the price action to validate the thesis. But unfortunately, at that time, the thesis is not valid anymore.
Correct.
So
Correct.
it's a great
Correct.
conclusion.
The thesis is proven true, but the money's already been made.
Yeah. Thank you. But to make this more easy for people, could you tell us a few more serially successful entrepreneurs in this business that everybody should pay attention to, if you have a few more names to follow?
Yeah, there's a guy named Richard Warke, Warke, in Vancouver. He is really, really, really easy to underestimate. He describes himself as morbidly obese. His fashion sense is sort of the same as mine, which is to say horrific. He doesn't cut his hair or comb it as often as he might. He will be amused if he hears this video. And he's had now 5 major successes. When you see him in person, it's very easy to underestimate the guy. But if you look back at his track record, and if you look at who his co-investors are, Ross Beatty, Frank Giustra, what you see is that he attracts the people in his community, Vancouver, that are close enough to watch what he's done over 20 or 25 years and join in with him. Another would be Jonathan Goodman.
Mm-hmm.
His father, Ned Goodman, was an important mentor of mine. John and I have known each other since we were in our 20s, which is a long time ago. John, I think, is really responsible for drawing me, as an example, to Reunion, which was a major recent success of mine, and also Magna Mining, which I think will be a future success. He built, of course, Dundee Precious Metals. He is a very low-key guy, not a flashy promoter. But he and his team, I think, as investors, do as good or better technical due diligence than any other merchant bankers on the scene. My friend Craig Perry has also been serially successful. He was part of the discovery team at NextGen, of course. Before that, he worked with Owen Haggerty in the Tigers Realm group in Australia. They had 2 or 3 successes. His Vizsla Silver looks to me like a very important silver discovery. It's not proven yet, but certainly the data that we have to date suggests that he's been successful again. So I think he's one that one needs to watch in terms of serial success.
Yeah. Then we have then we know more what work we should do after this video. In a few hours, you also have a Q&A session in the classroom, but after that, we should do that. And I should also mention, if I brought the classroom up, that I think end of August you had a Q&A session, and then at the end of the video you talked about with what other assets you diversify. So that I like that very much. So for people who are interested, it's easy to find. But thank you. And then back to the portfolio. Now the question was that the next question is, how many percentage would you recommend to hold in the natural resource sector? It is a difficult question. Maybe is it 10, 20% or 70, 80%? But I could also ask, how do you balance the risk reward concerning commodities? Then
to the extent that investors are willing to be investors, not speculators.
Yes, investors.
To the extent that they're willing to de-risk their portfolio and be bored, I think in the current circumstance, an argument can be made for having 30% of one's portfolio in natural resources. That's a high allocation for me. It's very difficult for me to understand why somebody wouldn't own physical gold and gold stocks. It's not hard for me to understand why they would. It's hard for me to understand why they wouldn't. If you have a 5 to 10 year time frame as an investor, which you should, you need to understand that for 30 years, we've been underinvesting in productive capacity and natural resources. At the same time as that, demographically, demand for natural resources has grown. And on a global basis, too, we've done a wonderful job lifting up the poorest of the poor, 2 billion of them, from abject poverty being merely poor. But there's still 1 billion people that need to be lifted up, and they will be over the next 20 or 25 years. And as they get lifted up, as they become more materially successful, what improves their life is commodity-centric, better housing, better diets, access to energy, travel. What that means is that with fits and starts, possibly even a temporary derailment from a recession or a depression or a war, the strong probability is that the entire natural resource complex does well. Because of that, if an investor is willing to be an investor as opposed to a speculator, there is an argument to be made for as much as 30% of one's portfolio in natural resources. Oil and gas right now are cheap. Industrial materials are cheap. The fundamentals of the uranium market are changing with the advent of term contracts, which completely changes the landscape for uranium producers. People who don't own gold and silver are, in my own mind, out of their minds. I mean, literally out of their minds.
Yeah.
And there are at least 4 commodity sectors: rare earths, platinum group metals, sulfide nickel, and perhaps agricultural chemicals, potash and phosphate, that are very, very cheap in historical standards and probably priced in terms of the marginal producers below the cost of production.
Yeah.
What that means is there are 4 or 5, also North American natural gas. That means that there are 4 or 5 sectors that meet our contrarian test. They are industries in liquidation, where if the price doesn't go up, the material becomes unavailable to humankind. Investing in these products that seem to be in liquidation when the price has to go up is something that's worked for me very, very, very well in the past. So if you look at that whole panoply of opportunity relative to opportunities available in other sectors, natural resource investing, if you can stand the boredom, is, I think, a really good place to be right now. The alternative to that would be that you invest in a sector where you believe you have a knowledge advantage over your competitors. If you're a biochemist, maybe you concentrate your activity in biotech, where you're competing with some guy like Rick Rule who doesn't know anything about biotech. But if you're asking a general portfolio question for the broad investing public, an argument can be made to be more overweight commodities, or as overweight commodities now as you should have been in 1998 to 2001.
Yeah. Okay. So it's similar, but even more in a sweet spot, I would say. And what you just told, I visited a stone mine in Hungary in the summer with my daughter, and I showed her that, look, it's not as exciting as Amazon or something like that,
Right.
But Amazon, where would Amazon be without highways? And to build highways, you need stone. So a rock bed, or I don't know, I'm not an expert, but they need stones. So like this is also something without Amazon would not exist. So yeah, and they need electricity, they need all kind of things. Yeah, okay.
I ask young people when I'm explaining these opportunities to point out to me anything in the world tangible that wasn't grown or mined.
Yeah. We
You
could
know, a
not
thought
speak without
experiment.
silver. Yeah.
If you go to McDonald's and eat a hamburger, what's the building built out of?
Yeah.
How did it get cooked?
Yeah.
What are the inputs? McDonald's is a pretty good business. They own a lot of real estate. They generate pretty good cash flow. I don't happen to like the food, but it's a different question. If you look at any of the popular brands and any of the popular services, and you try and explain to yourself how they might exist without agriculture and mining, you're stuck.
Yeah.
And by the way,
Yeah.
some of these tech high flyers, as an example, Google and Amazon, Microsoft, are all rushing headlong into the nuclear energy business.
Uranium, yeah. They need power plants, yeah.
Right.
Yeah, and you mentioned gold, and I want to show that this is one of my favorite books. It's this time is different. I really recommend it, but it's not a novel, so it's not for ordinary people. But this had a huge effect on me. And the one question is related to this one and gold, because most probably I think that the devaluation of our currencies, or as you would say, and you mentioned earlier, the devaluation of the net present value of the liabilities of the government will most likely happen. So that's why gold is also important. And despite it's already happening slowly, it could take maybe 40 years. So the question is that, are we worrying about something that will happen, but maybe in 30, 40 years? So practically, should it be a much smaller part of our investment thesis, as we like to think? That's only to challenge our gold narrative. What do you think about that?
Well, for validation, I'd ask you to look backwards as opposed to forwards.
Okay.
I began a systematic acquisition, my second systematic acquisition of gold bullion in 1998. And gold was selling then for about $300 an ounce. It fell to $252 an ounce, which means I, on paper, lost 15% of my investments. But in the period 2000 to 2024, it's gone from $252 to $2,600. In other words, an 8% compound rate of return for 24 years. When is gold going to move? 24 years ago.
Yeah.
I think that the set of circumstances that would propel gold higher are more compelling now than they were in the year 2000. But I think it's important to understand that there are people who have expectations of gold, which may occur, but you don't need those expectations. All you need is a continuation of gold's performance. Begin the period, if you want, in 1970. Take it all the way back 50 years. $35. I'm talking US dollars, not euros. $35 to $2,600 or $2,700. What gold does is it maintains your purchasing power. There are points in time in history where that's less important, points in time in history where it's more important. I think right now it's one of those points in time in history that are more important. I think that, too, the US dollar, despite its challenges, will likely be the best performing fiat currency. Because, as Doug Casey says, the US dollar seems to be the worst currency in the world, with the sole exception of all of the others. Or, as he also says, the prettiest slaughterhouse. So what my friend Brent Johnson says about the continued strength in the US dollar having a lot to do with the fact that most of the world's debt is dollar denominated, which secures demand for it, is all true. But that currency has, by my reckoning, lost its purchasing power at about 7.5% compounded over 24 years.
That's huge.
I remember back myself to the decade of the 1970s. I was alive and cognitive then, unlike many of your viewers. And the set of circumstances that was in front of the US then was markedly similar to the circumstance in front of us now. The solution to too much debt in the system was to devalue the purchasing power of the dollar. And in the period 1970 and 1980, the US dollar, by the government's reckoning, not mine, by the government's reckoning, lost 75% of its purchasing power. And that's precisely what I think is going to happen over the next 10 years. I don't think that we're going to, quote, default on our debt. I don't think that we're going to cancel Social Security. What I think is going to happen is that we're going to default, that we're going to depreciate away the net present value of these obligations. And I think the way that one protects themselves from that is gold.
Yes, at least partially. Yeah, this time is not different. So yeah, I highly recommended. Yeah, I agree. And it's not to really forecast, but I think one possibility is that we will have an inflationary depression. What do you think the chance is for that happening? And if there is a chance, how do you deal with it beside gold?
I think the chance of that is very high. That's what the 1970s was. A period of economic slowdown at the same time as inflation, so-called stagflation, the worst of all worlds. Yeah. This time will be better, by the way, not worse. It'll be better because the global community is more important than the US and Western Europe. The whole world was dependent on the US and Western Europe in 1970. The joke was when the US caught a cold, the whole rest of the world got pneumonia. There are other emerging places in the world, and they're shouldering a larger part of the economic burden. The investment in productive capacity and infrastructure in China and the proclivity for savings and education in China will, I think, spare us from some of the worst aspects of the unfolding American failures. I also think that we will continue to benefit from the implementation of new technologies, often in conjunction with each other, which will allow us to increase economic input with less capital input than we had in the past. One of the things that happened in the 1970s is with very high interest rates and with scarce capital, that although there were products that were needed to bring to market, the capital to cause that to occur didn't exist. With information technologies, with information processing technologies, with various technologies and the interplay of those technologies, what you're beginning to see is the more efficient generation of utility relative to capital employed. And so, although I think that stagflation is something that's in its future, I think the world's abilities to get through stagflation is much more attractive. We don't think about it in the Western Europe and in North America, but the global response to stagflation in the 70s in places like South America, Central Asia, Africa, was starvation. We lost our jobs. We lost our savings. They lost their lives. And I don't think, absent war, which can accompany economic dislocation, absent war, I think we'll get through this one better than we got through prior ones. But I also know that there was a whole generation of people, myself included, who handled themselves reasonably well during the 1970s. And when the rest of the world did poorly, they did well. Now, in my particular case, I forgot to adjust for the 1980s. So when other people did well, at least in the first half of that decade, I did very poorly. And I would hope that people who orient themselves well to the next decade understand that there will be, at some point in time in the future, the need for a second paradigm shift.
Mhm. Yeah, yeah. Okay. Thank you. Thank you. Very interesting. And do you think, just quickly, that the government interference now is worse or better than in the 70s?
Much worse.
Much worse.
Much
Oh,
worse.
okay.
Yeah.
I stopped
Much,
there.
much, much worse.
Yeah.
Yeah.
Okay.
You
That
know,
is what I
in
don't
the
know.
70s, actually all the way to 1992, while the Fed and the government could do their best to manipulate the interest rate, there was a group of people that they laughingly called the bond vigilantes. Uh, Bill Clinton himself said if he died, he wanted to come back as the bond market because it was the most powerful force in humankind. The market in the period 1992 to 2022 lost control of the interest rate. I think the market will reassert control over the interest rate, and I think that'll be pretty ugly.
Yeah. Yeah.
But the impact of government around the world and in virtually every aspect of our lives is much more pervasive now. And the popularity of government, this is astonishing to me, but the popularity of government is high. People, it seems to be, don't want control of their lives. They want to assign responsibility for their well-being to others. And they also want other people to follow their own dictates. I'm, by the way, fighting very hard to change that. I'm involved in things like Students for Liberty, which last year talked to 160,000 students worldwide. But I think it's a fight that it's very important that we have.
Yeah. Yeah. Thank you for doing that. Yeah.
Pleasure.
I agree. I agree. Governments should leave us alone. Okay. I have to keep the time in mind, so I would like to jump to stocks. I have a few more. What do you think about newfound gold?
I disagree with my mentor, Eric Sprott, on this one. It's difficult when I look at the cross sections to tie it together and make a big deposit out of it. I see a bunch of little deposits.
Yes.
So I think that the market cap, or at least the enterprise value, is higher, or pardon me, lower than the current market price. I don't own it. I'm not trying to say there isn't potential there. What I'm trying to say is until I have data that supports that potential, I'm not going to own the stock.
Mm-hmm.
I have newfound gold as a 6. I would have it as a 7 were it not for the promotional capabilities of the team and the supporters.
Yeah. Okay. Okay. So it's a high concentration what we see, but it's a small little pockets, and you
Correct.
don't. Oh, okay. Okay.
I have a difficult time seeing how you make a mine out of a big mine.
Okay. What do you think about gold royalty? I got a lot of questions. And do you think, or do you see this kind of dilution as a red flag? What do you think about that?
Do I see that kind of dilution as a red flag? Yes,
Yeah.
I do. I've known Amir Adnani almost since he was in diapers, and I have a very, very high regard for the guy. He has learned that to employ capital, you must have capital. And the dilution that he took in the 1990s, which was massive, resulted in the company that you see today. I think the price of gold royalty used to be way, way, way ahead of itself. I'm impressed to see the asset growth at the same time as you see an enterprise value decline. So I own gold royalty. People who own it need to understand that Amir, when capital is available, will take it. He's a very aggressive young man, and he has learned in capital-intensive businesses to survive and thrive, you must have capital. I think that there will come a time, and I hope Amir watches this video. I don't talk about people behind their backs. I hope there will come a time in Amir's life when he begins to talk about accretion and dilution on a per share basis rather than on an enterprise basis.
Okay. Yeah, recently I did not check the price of it, but I know it went down. and that was positive. But you know, the people are afraid of further dilution, so that's why. Okay.
And they should be.
Yeah. Okay. Thank you for your honesty. What do you think about Ivanhoe Electric?
I'm a shareholder.
Yeah, me too.
I'm a huge fan of Robert Friedland.
Yeah.
I've known Robert. I've done business with Robert for 40 years, and it's mostly been pleasant. A lot of the price of Ivanhoe Electric depends on whether or not their, in effect, seismic technology, the iPulse technology, proves to be as efficacious in exploration as they hope it will be. Certainly, there is value in the Santa Cruz copper deposit. They've done a wonderful job drilling that thing.
That is in Arizona, right?
Pardon me? Yes.
Yeah.
Yes. And importantly, it's on private land.
Yeah.
So the permitting issues that things like resolution are facing don't face them. But really, the upside is all about the application of their exploration technology around the world on projects that other people haven't been able to explore efficiently. So understand that this is a grand speculation. For me personally, I made so much money on Ivanhoe, the original Ivanhoe,
Yeah.
that my investment in Ivanhoe Electric is the equivalent of going into a casino and betting 5% of your winnings on a new table.
Mm-hmm.
People need to understand that.
Yeah, I understand. Yeah. Okay. McEwen mining and McEwen copper, which will come maybe next year. What do you think about that?
McEwen, Rob, I think, is about 3/4 of the way through the reorganization of McEwen Mining.
Mm-hmm.
He got way too aggressive, which he acknowledges. And he consolidated assets that were decidedly second-tier assets. And he paid for it. Unlike most guys, Rob was completely honest with himself. He sat down, took a look at what he did wrong, and he began the very painful process of righting it. I think that there is value in McEwen Mining, although I don't own it. I prefer tier one projects. But those projects under the stewardship of Rob McEwen will attract a market following in a gold bull market.
Mm-hmm.
And there's a lot of leverage to the upside in the gold price. I don't own it because I like higher quality assets. Now, in McEwen Copper, you have a genuine tier one copper asset. Well, let me rephrase that. In terms of size and grade, you do. The topography in a valley bottom is difficult. It means that the strip ratio coming out of the valley gets very high.
Mm-hmm.
So whether or not it meets the tier one criterion in terms of global distribution of all-in sustaining costs and return on capital employed is a different question. But it is certainly, in terms of in situ recoverable reserves and resources, one of the top 20 undeveloped copper deposits in the world. I'm bullish about copper over 5 years. So I am attracted to that asset on an optionality basis. When we see a new pre-feasibility study and later a bankable feasibility study, we'll have a better answer as to what the return on capital employed looks like and where it sits on the cost curve worldwide. Mm-hmm. If those unanswered questions get answered favorably, I've got a long happy history with Rob McEwen, and I'll come into that stock. I need to say I don't own either of them today.
Okay, thank you. I have one more. Maybe we have time for that. Power metal resources, and do you think of that? Yeah.
Power is a speculation. So people who want to own it need to understand that they're participating in a nascent merchant bank that's subscale. They need to have an understanding and an interest in the business plan, which is basically starting small mining companies. You get in on the ground floor by creating the ground floor, which is what power is all about. It's something I used to do a lot of. I don't have the time and the energy to do it anymore. So I'm investing in a third party that's doing it, in effect, for me. Whether they'll be as good at it as I was is a different question. I don't know. This is something that will either cost you half your money or make you 10 or 15 times your money. And I'm not sure which, to be honest with you. What they are setting out to do is, I've done a lot of it, extremely risky, extremely time intensive and labor intensive, extremely tricky. And if you do it, it's extremely lucrative. The time will tell if this team can do it and if they can get up to scale. I mean, understand that this is a company with $20–25 million in assets, where really to be viable as a public company, they need $100 million in assets. So the risk is, can they scale up quickly enough that they don't cannibalize themselves with the general and administrative expense involved in being public?
Mm-hmm. Mm-hmm. Yeah. The same is true for Empress royalty.
Absolutely. Exactly the same comment. I really like the team. At Empress, you have the durable competitive advantage of their tie-in to Endeavor, which means that they see more and better deal flow than other equivalent companies their size. But the challenge is the same. Bulking up before the G&A associated with being a public company cannibalizes the net present value of the assets.
Yes, yes, yes. Okay, I understand. Yeah, time is limited. Thank you very much. We appreciate it that you had time for us, and I hope that we can meet soon.
Thank you so much. Thank you for flattering me with thoughtful questions.
I enjoyed it.
I'd like to leave your audience once again with the invitation to, if you like what I had to say about natural resource investing, personalize it. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks, and for no obligation and no charge, I will personally rank them 1 to 10 and comment on individual issues where I think my comments might have value. In addition, for serious investors and speculators, remember this Saturday, we're putting on the Tier 1 Deposit Bootcamp. If you are a real investor in natural resources and precious metals, I think these boot camps have the ability to change the way that you think and invest for the better. Your investment right now will be $99 US, fully refundable if you think we failed, and 8 hours of your time, which you'll never get back. Note that well over 99% of the people who have made this type of investment in the past over 28 years have come away more than happy. Thank you.
I'm one of those. Okay, thank you very much. Thank you, and see you later. Thank you.
Pleasure. Thank you.
Goodbye.
Bye-bye.